Okay, let's dive in. You've given us this really comprehensive set of materials today. Financial reports, market studies, news, your notes, all focused on Apple Inc.
Yeah, it's quite the collection. A great chance to really, get into the details of a company that's just so present in our lives.
Absolutely. And our goal here, our mission for this deep dive is pretty straightforward. We want to walk through this material together, find the most crucial insights, and basically help you get a really solid handle on Apple's business.
What makes them pick, where they stand in the market, how healthy they are financially.
Exactly. And what the outlook is based on everything we have here.
We'll pull out those key nuggets, sort of distill it down so you get the essence without having to read every single report yourself.
Consider it the express lane to being well informed on Apple. Let's get started. So, maybe starting right at the core, what do these sources tell us about Apple's fundamental identity? What's driving them?
Well, the materials really emphasize this long-standing mission, to bring the best personal computing, the best user experience through innovative hardware, software, internet stuff.
Like about high quality, right? Innovation,
Yeah.
and making sure everything just works together.
Exactly. And their vision statement is pretty bold, too. We believe that we are on the face of the earth to make great products, and that's not changing. No mincing words there.
Yeah, that's a clear commitment. And it ties into their core values, like innovation, simplicity.
Excellence, leadership, integrity.
Yeah.
Yeah. And they also talk about broader principles, accessibility, education, environment, privacy, supplier responsibility. These seem increasingly important.
And you see this reflected in their actual business, right? Designing and selling the iPhone is still the big one. Macs, iPads, wearables like AirPods, the watch, HomePods.
And, yeah, that services division, it's become so critical.
Things like the App Store, Music, TV Plus, iCloud, AppleCare, Pay. It's a whole suite built around those devices.
Which leads directly into this idea of the integrated ecosystem, the walled garden, as it's often called.
Right, the sources talk a lot about that.
And the strategy is clear. Make the hardware, software, and services work together seamlessly.
Yeah, and the analysis points out this gives them a pretty major advantage. Once you have an iPhone, maybe an Apple Watch, maybe a Mac.
It just gets harder to leave, right?
Yeah.
The convenience factor.
They call it switching costs. They become pretty substantial.
And that fuels customer loyalty. And importantly, it drives recurring revenue, especially from services and the App Store.
I saw one source put it really bluntly. Hardware is Apple's moat.
That makes sense.
Yeah.
It's the physical foundation for this really sticky digital experience they've created.
And the scale is just, wow, over 2 billion active devices. That's a massive user base to build on.
And having that strong brand, that loyal base, it lets them pursue their premium strategy.
Right. Focus on exceptional quality, design elegance, and charge more for it.
Exactly. Which, as you pointed out, creates a bit of a tension. They're not always going for the biggest market share, especially in, say, emerging markets where price is key.
They seem to prioritize profit per device and maintaining that high-end image over just raw volume.
Yeah, and that requires huge investment. R&D, materials, manufacturing, it all has to be top-notch to justify the price.
Okay, just quickly, the basics. Where's the mothership?
Still Apple Park, Cupertino, California. Tim Cook's been CEO since August 2011, took over from Steve Jobs, and really shaped the company's evolution since then.
And the stock, for those tracking it, is AEPL on the NASDAQ. Simple enough.
Okay, so let's zoom out a bit. Look at the markets Apple plays in. They're huge.
Smartphones are still king revenue-wise, yeah. The numbers here show like $580 billion this year, maybe $840 billion by 2030.
Right, but the key thing is the growth rate. The projections are, mid-single digits, 6-7% CAGR. It's a mature market, basically.
Okay, contrast that with PCs where the Mac sits. Still a big market. $222 billion going to maybe $344 billion, but growing faster. Over 9% CAGR.
Yeah, a bit more growth there. And wearables, the watch, AirPods, that looks even more dynamic.
The U.S. market alone is projected at nearly 13% growth through 2030. Lots of potential, especially in health and fitness applications.
But the real growth story, looking at these projections, is digital services overall.
I saw that. It's already enormous, like $4.2 trillion, heading towards maybe $10 trillion by 2033.
Exactly. And within that, specific areas are just booming. Cloud services growth projections are like 18 to over 21%. Music and video streaming both around 17-18% CAGR.
Wow. Even mobile gaming, which drives so much App Store revenue, is still pegged at over 6% growth.
So the takeaway here is pretty clear when you compare them. Hardware growth is okay, maybe low double digits at best,
Yeah.
but services growth is much higher, mid to high teens.
Which strongly suggests that the services division is really the engine Apple's counting on for future growth, right? To keep that overall company growth rate up.
Absolutely, it's crucial. And the App Store is a huge part of that. But its size and the commissions, the Apple tax, that also brings regulatory headaches, people looking closely at their market power.
And so in these massive markets, who are they really up against?
Well, they compete everywhere, obviously. But the analysis identifies Microsoft, Alphabet, Google, and Amazon as the big three. The most formidable competitors, because they're also huge and operate across so many of the same areas.
Yeah, the competitive table you included puts that in perspective. Apple's around a $3 trillion market cap, nearly $400 billion revenue recently.
But look at Microsoft, even bigger market cap, $3.4 trillion, over $260 billion revenue. And Google and Amazon are both over $2 trillion market cap, with massive revenues too.
So these are true tech titans fighting for share in devices, cloud, services, advertising. It's intense.
Which brings us back to Apple's defenses, their competitive moat. The sources rate it really highly. A wide moat, one says, 9 out of 10.
So what builds that moat? What are the pillars?
First and foremost, the brand and that customer loyalty. It's consistently ranked among the most valuable brands globally. Super high satisfaction, people stick with them, which lets them charge premium prices.
Then the ecosystem we talked about, that seamless integration across, 2 billion plus devices now, makes it hard to leave, creates those switching costs.
Right, the hardware really anchors the services.
Yeah.
Then there's innovation. They spend a ton on R&D.
Over $30 billion in 2023 alone.
Yeah, driving things like their own custom chips, and now this big push into AI.
They also get those network effects, right? Lots of users attract lots of developers, which makes the platform better for users, a virtuous cycle.
Exactly. All that adds up to significant pricing power, which you see in their margins. Plus, they have valuable patents and trademarks.
The analysis does suggest, though, that maintaining this moat long-term really depends on keeping that innovation engine running, especially in services, as hardware changes maybe become less dramatic year to year.
And it's interesting how they're now positioning privacy, calling their AI approach privacy first.
Yeah, how so?
The thinking seems to be that this can be a real differentiator. Attract customers who are concerned about data, maybe justify the premium price, and even turn regulatory pressure around privacy into an advantage.
Okay, let's dig into the numbers, the financials. Looking at the income statement for the last few years, 24, 23, 22, what's the story with revenue?
Which shows growth has moderated a bit, peaked in FY22 at $394 billion, then a slight dip in 23 to $383 billion, and a modest recovery in 24 to $391 billion.
Yeah.
Still huge numbers, obviously.
But not the explosive growth of earlier years, suggests maybe market saturation, macro factors.
Yeah, or just product cycle timing. It's harder to maintain super high growth at this scale. Net income kind of followed the same path, down from nearly $100 billion in FY22 to around $94 billion in FY24.
And the balance sheet, assets look pretty stable.
They are, yeah, around $350 to $365 billion. What's more interesting maybe is the debt. Total debt has been consistently coming down.
Oh, yeah. From $120 billion in FY22 to $105 billion in FY24.
Right. Suggests they're actively deleveraging, probably using some of that massive cash flow they generate.
Now, the ratios. This is where it gets really interesting. Return on equity, ROE.
Yeah.
Astronomical.
It really is. I mean, numbers like 175%, 172%, 157% over the last 3 years. That indicates incredibly efficient use of shareholder money to generate profit. Outstanding profitability.
But wait, the material flags something important here, a nuance about that super high ROE.
Yes, absolutely critical point. Well, the profit is strong. That ROE number is significantly boosted, amplified, really by their huge share buyback programs.
How does that work?
Well, ROE is net income divided by shareholders' equity. By buying back massive amounts of stock, Apple reduces the shareholders' equity figure, the denominator. So even if net income isn't soaring, the ratio itself shoots way up.
Ah, okay, so the equity base shrinks, which mathematically inflates the ROE percentage. Their equity actually went down between FY21 and FY24, despite huge profits.
Exactly. It's smart financial management, maybe,
Yeah.
but you have to understand it's not just operational profit driving that specific ratio so high.
Gotcha. Okay, what about liquidity? The current ratio. It's consistently below 1.0.
Yeah, 0.88, 0.99, 0.87, usually below 1.0 is a warning sign, suggesting trouble paying short-term bills.
But maybe not for Apple.
The analysis is probably not alarming for them because they have such strong, predictable cash flow, tons of liquid investments, and easy access to borrowing if needed. It suggests really tight, efficient working capital management.
But it relies on that cash flow continuing to be strong.
Definitely. That's the caveat. Any significant weakening there could make that low ratio a problem quickly.
And debt to equity, how leveraged are they?
That ratio actually decreased from 2.37 in FY22 down to around 1.8 recently. So less reliant on debt compared to equity lately.
Though again, the shrinking equity from buybacks affects this calculation too, right?
It does. Historically, you could argue the high ROE combined with the debt suggested they were using leverage effectively to boost returns. The recent dips suggest maybe a bit less reliance on debt now, or just paying it down faster than equity is shrinking.
Okay, let's talk valuation. How's the market pricing Apple stock? Based on the late May 2025 data, around $200 a share, $3 trillion market cap.
Right, so the price to earnings ratio, PE, was about 31.3. Price to sales, PS, around 7.6, and EBITDA was about 24.
How does that stack up against Microsoft, Google, Amazon?
Well, the PE is kind of mid to high compared to them, but the PS and EBITDA ratios are definitely on the high side.
Higher PS than Google and Amazon, only lower than Microsoft, and EV/EBITDA higher than Google and Amazon too.
Yeah, pretty much neck and neck with Microsoft on EV/EBITDA, but clearly higher than the other two giants.
So the market's definitely awarding Apple a premium valuation. Why? What justifies that?
The sources point to the usual suspects. That incredibly powerful brand, the sticky ecosystem, the proven profitability, high margins, that ROE we discussed, market leadership, relatively stable earnings, and, those huge share buyback and dividend programs returning cash to shareholders.
Investors seem to trust the stability and predictability of their future cash flows, basically.
That seems to be the perception, yeah. Anchored by that ecosystem.
But that premium price tag comes with high expectations baked in, right?
Absolutely.
Yeah.
The valuation assumes continued strong performance. They need to keep innovating, growing services, making AI pay off, maybe getting traction with Vision Pro to justify these kinds of multiples long term.
If growth stalls or margins shrink,
then there's definitely a risk the market could re-rate the stock lower. That premium could evaporate.
Okay, let's try and pull this all together. A classic SWOT analysis, strengths, weaknesses, opportunities, threats, based on everything we've seen in the materials. Strengths first.
Top of the list has to be the brand and loyalty, just dominant. Then the integrated ecosystem, the switching costs, that huge 2 billion device base.
Innovation leadership too, right? Driven by that massive R&D spend, custom chips, AI focus.
And their financial strength is undeniable. Tons of cash, high profits, and that fast-growing, high-margin services segment is a huge plus, providing recurring revenue.
Okay, weaknesses. What are the vulnerabilities?
The big one is still iPhone dependency. Over half their revenue comes from one product line facing a mature market. That's a risk.
The premium pricing limits their reach, especially in emerging markets.
Right. And their supply chain, while efficient, is complex and heavily concentrated in Asia. That's a geopolitical vulnerability.
Plus, the walled garden itself, while a strength, can also be seen as restrictive and attract that regulatory heat we mentioned.
Okay, opportunities. Where's the upside?
Services, services, services. Keep expanding that. The sources mentioned targets like a $110 billion run rate, 1.5 billion subs, plus new AI-driven services.
The big AI push with Apple Intelligence is obviously key. That privacy-first, on-device approach is their angle. They're aiming for it across almost all products soon.
Growth in emerging markets, India, Southeast Asia, tapping into the middle class there.
Definitely. And the health and wellness space, with the Apple Watch leading the charge, integrating more into healthcare.
And longer term, maybe AR/VR with Vision Pro. It's early days, but the potential market is huge.
True. Okay, threats. What keeps them up at night?
Intense competition. Microsoft, Google, Amazon breathing down their necks, plus hardware rivals chipping away on price.
Regulatory scrutiny seems to be escalating everywhere. App Store rules, antitrust concerns.
Geopolitical risks are huge, tied to that Asia manufacturing dependence, tariffs, disruptions, trade wars.
The sheer pace of tech change is always a threat. AI is moving fast, and macroeconomic headwinds, slowdowns, inflation could really hit demand for their expensive products.
And, the risk of a major product defect or recall hurting that premium brand image.
The materials also specifically pull out the top 3 risks from Apple's own annual report.
Right. Number 1, macroeconomic and industry risks, global conditions, recessions, inflation affecting demand and suppliers.
Number 2, political events, trade disputes, business interruptions reflecting their global operations, and that Asia reliance.
And number 3, Highly competitive and rapidly changing markets, the constant need for successful innovation, fighting off copycats.
And you can see how these are all linked, right? Geopolitics affects the macroeconomy, which affects supply chains and competition. And that premium strategy is vulnerable in a downturn.
Okay, so shifting to their actual growth strategy and outlook, how are they planning to navigate all this?
Well, the official strategy summary really doubles down on the themes we've seen. Continuous innovation tech, design, experience, R&D, chips, AI.
Deepening and expanding the ecosystem, making it even stickier.
Absolutely. And accelerating services growth. They have explicit targets there, positioning themselves as leaders in AI with Apple Intelligence, really leaning into that privacy angle.
Plus those strategic investments like the big $500 billion commitment in the U.S., the AI server facility in Houston.
Yeah, that's about jobs and investment, but also AI infrastructure, and maybe diversifying their footprint a bit.
They're also focused on global growth, localization, emerging markets, and trying to stay true to their values, environment, privacy.
So looking ahead, what are analysts expecting? The consensus for FY 2026.
Modest revenue growth, actually, around 3.75%, projecting just over $419 billion.
Okay, but earnings per share, EPS, growth is forecast higher, around 7.85%.
Yeah, so EPS growing faster than revenue usually implies one of two things, or both. Either margins are expanding, maybe that shift to higher margin services is paying off, or they're continuing to buy back a lot of stock, reducing the share count.
Makes sense. The revenue forecast reflects that challenge of growing such a huge company in mature markets.
Yeah.
They really need those newer things, Vision Pro, AI monetization, emerging markets to kick in to really accelerate growth beyond that modest level.
Everyone's watching to see if Apple Intelligence really catches on and drives upgrades or new services.
And we saw some recent news, right? Late 2024 into May 2025. Their Q2 results look pretty solid.
Yeah, early May, $95.4 billion revenue, up 5% year over year, EPS up 8%. And crucially, they generated $24 billion in operating cash flow just in that quarter.
Wow. And returned $29 billion to shareholders. Shows that financial engine is still humming.
We also saw news about Apple Intelligence rolling out to new languages, new regions, getting integrated into Vision Pro back in March. So tangible progress on that key AI strategy.
And that reinforced commitment to U.S. investment, the Houston facility. They also highlighted the scale of the App Store ecosystem, like $400 billion in developer billings in the U.S. alone in 2024.
Right. So the recent updates show basically continued operational strength, execution on AI, robust financials funding investment and shareholder returns. That cash flow is just immense.
Thinking about the leadership, Tim Cook's background seems really suited to Apple's operational needs, doesn't it?
It really does. Before becoming CEO, his whole career was essentially in operations and supply chain Compaq, IBM, then running Apple's ops.
He's the one credited with building and optimizing that incredibly complex global supply chain that allows Apple to operate at scale and maintain profitability.
Right, and under his leadership, they launched the Watch, Vision Pro, really pushed into services. He's also become a prominent voice on issues like privacy, environment, human rights.
Yeah, definitely shaped the company's public image in that regard. More focused on operational efficiency and maybe broader responsibility compared to jobs focus, perhaps.
And ownership-wise, who holds the big stakes?
Vanguard is the largest institutional holder, mentioned as having around 8.76% end of 2023. BlackRock is up there too.
Which mostly reflects Apple's huge size, right? They have to own it for their big index funds.
Exactly. Largely passive stakes driven by market cap. They have voting power, but usually only get heavily involved if there are major governance or ESG issues.
Speaking of ESG, environmental, social, governance, the materials included some ratings. How does Apple score there?
It's a bit mixed, depending on who you ask. Sustainalytics gives them a low-risk score, 18.75 as of April 2025. They highlight things like business ethics, human capital, data privacy as key areas.
But S&P Global has them at 43 out of 100, which is just kind of average for the industry. Their score is higher on environment than social or governance.
Right. The different agencies just weigh things differently.
Yeah.
But the analysis suggests Apple views things like privacy and environment strategically.
Not just box ticking, but actually using it to boost the brand, manage regulatory risk, attract talent, appeal to certain investors.
Exactly. It seems baked into their business strategy now.
Okay. Wow. We have covered a lot of ground here, pulling from all these sources. Let's try to quickly recap the main takeaways.
Yeah, summarizing. Apple's power clearly comes from that incredibly strong brand and the deeply integrated ecosystem locking in over 2 billion devices. Financially, they're a powerhouse, exceptional profits, huge cash flow, allowing massive investment and shareholder returns while also paying down debt.
And the crucial insight seems to be that the high-margin services segment is really the key growth driver going forward as hardware markets mature. Their strategy revolves around innovation, especially AI now, making the ecosystem stickier and targeted global investments.
But the flip side is significant risk. Still heavily reliant on the iPhone, facing intense competition from other tech giants, growing regulatory pressure worldwide, and those geopolitical risks tied to the supply chain.
Plus, their premium pricing makes them vulnerable if the economy turns down.
It's a picture of a dominant, incredibly successful company, but one facing real challenges in maintaining its trajectory at such a massive scale in a fast-changing world.
The financial strength is there, but defending the moat and finding new growth avenues under increasing scrutiny, that's the core challenge.
Right, absolutely.
This may be a final thought for you to chew on after this deep dive. Given this landscape, the competition, the need for constant innovation, the regulatory pressures, how does Apple strike that balance? How do they weigh their commitment to premium pricing and privacy against potentially needing broader reach or maybe even different business models to stay on top in the long run?
Yeah, that's a fascinating question. How do they evolve without diluting what makes them Apple?
Exactly. Something to consider. Well, thanks for digging into Apple with us today. We'll catch you on the next Depth Dive.